Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
Here's some news that all of us could use. At one of the most divided times in our nation's history, Abraham Lincoln reminded all of us he was a transcendent messenger with a transcendent message. What he told us is a nation divided against itself cannot stand. We feel divided today, and we need to be reminded of what Abraham Lincoln told us. Jesus also told us this. In fact, Jesus is the one who informed Abraham Lincoln when he said that every kingdom divided against itself will be ruined, and every city or household divided against itself will not stand. Whether it's at home, whether it's at the workplace, whether it's in our neighborhood, whether it's our nation, we all have so much to be grateful for. And rather than let those things that, well, let's just say we don't agree on divide us, we need to be reminded, just like God in relationship with us reminds us, He's for everyone. That is God. He's not for everything, but He's for everyone, even though He's not for everything. And I think if today we could just leave with a bit of inspiration to live our lives in that way, inspired by Jesus, inspired by Abraham Lincoln, inspired by God Himself, to be in relationship with others in this way, to be for everyone. We can still not agree on everything, but we can finally be for everyone. Let's do that. Here's some other news you can use about the economy and about the housing industry. And I'm so grateful here on News You Can Use that we can welcome back our dear friend and one of the top economists worldwide, specifically in the housing industry, which is important to you and to me. Doug Duncan, welcome back to News You Can Use.
Good morning. Thanks for having me. Glad to be with you.
So this year, right? We're getting ready to head into the fourth quarter. It feels like it's been the longest year of my life, right? So way back in the beginning of the year, in February, you and I had an exchange here on News You Can Use. And here's what the conditions were. We're coming into a year with the lowest unemployment rate in history, 3.5%, with the lowest fixed rate in history, 3.5%. We did have inventory concerns in the real estate market. And you were projecting at the time a 2.7% year over year increase in sales, which was up from the previous year. And by the way, I'll remind you and the folks that are your bosses at Fannie Mae that you had a pretty darn good year in 2019 forecasting, right? You were up by 0.1%, which anyone would take. And then right after we finished that meeting, a black swan showed up called COVID-19. And it changed everything. For the first time in our lives, we actually put the economy into a coma, a self-induced coma. We actually decided that to arrest or flatten the curve, as it was called, this virus and the spread of it, so we could get medically prepared for it, we put the economy into a coma. And within the span of 3 months, excuse me, we went from 3.5% to almost 14% unemployment. Our GDP, which, my goodness gracious, when I look back now, 32.9% in the second quarter, down. Housing in the second quarter touched 35% off of, I guess, our run rates. Rates, in fact, did go lower, but then we started to reopen. When you look back now at the moment when we self-induced, what were you and your team thinking about how you were going to begin to forecast 2020?
Well, the first thing we had to do is recognize what we didn't know. And we don't know, we're not doctors or medical scientists. So what we don't know is anything about how the disease would develop. So we actually changed our thinking to more of a scenario-based approach rather than a formal forecast. Because a forecast makes some assumptions about normal longer-term relationships, but with scenarios, you simply posit how certain things might happen. And that's really what we needed to do. So the first thing that we thought was, the question is, what's the incidence, severity, and duration of the disease? What can we learn about that from medical scientists? And then based on what we think that will look like. How will people behave? How will businesses respond to people's behavior and businesses themselves behave? And then what will policymakers do? And of course, all of that took some time to unfold. So the big debate among the leadership was, is there any potential for a V-shaped recovery? And of course, then we went through the whole alphabet, and then we went to square roots. And
now we have K. Right now we have K. We've added a K.
Right. So, but all that does is show you that if a non-economic variable gets introduced, then you have to be very humble about what it is that you can conclude from how the economy will perform.
So what's been good is that we have actually made progress since May, and actually at a rate that has been surprising to me. Maybe not to you and to your forecasting team, but I looked at your most recent forecast in September, and I continue to see you all upgrading, being a bit more optimistic about how the fourth quarter and otherwise things might turn out. What surprised you since the forecasting in May with the self-induced coma, with the economy? What surprised you along the way?
I think after the initial response of fear, people actually moved to partly to your opening comments. People need people and want to be in relationship to people. So there's a certain level at which the fear started to be overridden by other human nature necessities. And that's still a matter of public debate. And you can see in the States took a really severe lockdown approach, that the economic decline is much bigger than it is in those states which took a less severe lockdown. But of course, the infection rates were higher in those states that took less severe lockdowns. So the point is, from the human perspective, trade-off as we're learning. And I think we have upgraded our forecast, and we've been above the consensus full time, and we're pretty far above consensus right at the moment. But it is based largely on our observing what people actually have been doing relative to the change in the life.
Yeah, to that point, as I shared with you before we started, I went out to dinner on Saturday evening, and in a relatively conservative area, and they weren't college kids. These were grown, what appeared to be mature adults. But the place was packed, and had you not known that COVID was going on, you would not have known there was a thing called COVID at all, because people were acting it out normal. And I think that's probably what we're seeing most right now, which is people really desiring to go back to some degree of normalcy. We also talked a bit about football. And even though both of our teams are now a combined 0-4 after the first couple of weeks, it's good that we can actually begin to have some degree of normalcy come back. Talk about the overall economic update, GDP, kind of unemployment. What are you all, where are you at today in terms of your forecast, and how are you feeling about the fourth quarter and into 2021?
So if you go back to our April timeframe, you'll see that our expectation was that the economy at the end of this year, that is 2020, would be about 5% smaller in real dollars than it was at the end of 2019. We've cut that in roughly in half. We now think it'll only be about 2.5% smaller. That's still very important. And next year, 2021, we think we will recapture most of that. So essentially, over a 2-year period, the US economy in terms of real incomes will not have grown. If that's the case, and you see population workforce growth, then necessarily the unemployment rate will rise. So we would expect to see the unemployment rate at the end of next year somewhere around 6%. There's lots of risks. There's both upside and downside risks. The upside risk we talked about a little while ago, the savings rate's very high. It's more than double the long-term average. But the distribution of that savings rate is more in middle and higher income households, and the unemployment is in the lower income households. That's really a tragic story of the virus, because you cited that 3.5% unemployment rate. For the last 3 years or so, the incomes for lower income households was growing faster than for middle and upper income households, which was a really good thing. The virus truncated that. From a housing perspective, that had more impact on the rental side of the business than on the ownership side. So right now there's, in the mortgage space, there's something like 7% of all outstanding mortgages that are in a forbearance of some sort. But that's actually much lower than what the original thinking was on how this might happen. That's the silver lining, I guess, in a dark cloud.
So it gives argument that this K, the newest, latest alphabet that's come out, is kind of playing itself out now, and it's not necessarily intentional on anyone's part. It's just the reality of the service sectors being more impacted than otherwise the employment marketplace. All right, so now let's talk housing. I think the audience is very interested. I think for me, when I asked you the question, what surprised you, I must admit, in April, May, I had great concern about our industry, just in general. About people feeling comfortable enough to go extend themselves at a time of, arguably in my lifetime, other than September 11th, it was the greatest uncertainty I felt as an adult. So where were we in housing, and where are we, and where do you expect, you and the team at Fannie, where do you expect we're going in the fourth quarter and into 2021?
Well, if you look at home sales and purchase mortgage volumes, and you look at our February forecast, it's going to look a lot like our September forecast. We're kind of back where we were. You mentioned supply issues at one point. Actually, the supply issues are the story of why housing is doing as well as it is. In the April timeframe, at the Fannie Mae board meeting, they looked at our forecast and they said, how is it that you have house prices rising? And we're like, well, if supply falls faster than demand, the Economics 101 says price will go up. And our National Housing Survey showed us, which we do monthly, showed us that the people who were potentially on the supply side of the equation, they had a house they could sell, were much more depressed about the environment than those who would conceivably be on the purchase side of the equation, where the virus was impacting people's willingness to sell their house. They didn't want somebody walking through the house that had a virus. They were afraid people wouldn't even come and look because of the virus. On the demand side of the equation, people are saying, but interest rates are at historic lows. This is a great time to buy a house if you have a salary and you believe that your income is stable. So that difference in the responses of supply and demand kept house prices up. That has continued forward now as people have learned more about the virus, like we were talking just a couple of minutes ago, and become more confident. I'm not an older person that has a comorbidity like obesity or a smoking problem or a cancer situation. I'm not one of those people. So chances are pretty good this is going to pass me by. That has lifted people's optimism in the housing market. It's still the case that the demand side is operating stronger than the supply side, but the supply side is coming back. So our forecast looks a lot like it did in February, which was a good forecast for the housing market.
Yeah, no, it's I actually, when I saw the September update that you did, and I saw the fourth quarter pickup and going into next year, because I think there's folks in housing that have really enjoyed a great year, and we've encouraged everyone to be generous and give back to neighbors, particularly those that have been hurt by the entire event from an employment standpoint. But it really has felt like you just keep getting concerned that the shoe's going to drop at some point. And so when I saw your forecast, my spirit was buoyed, because I was thinking, okay, so you find folks as good as anyone is in the country at forecasting housing are continuing to believe that we've got momentum and we've got a floor underneath us. Now, we know that can change, and we'll get to a couple of things that could change that here in just a minute. You know, one of the things that you said earlier, I just want to go back to now, because of course, our interests, the folks that are watching the program today, most of them are in Atlanta, Fort Lauderdale, Tampa, Charlotte, so large cities in the Southeast. There's a different impact that COVID has had across the country. It's gone through at different cycles. It went through New York and New Jersey, the Northeast and the Southeast, and of course now it's in the Midwest. The reaction by government, local, has been different in terms of shutting down, not shutting down, opening back up, slowly opening back up. How do you feel like it plays out now in terms of the Southeast as a comparison, for instance, to the Northeast in housing? Do you all forecast the national numbers, and then are you looking at it just being more favorable in more cities that are kind of in the Southeast and the Northeast? What's your thoughts about that?
Well, we've actually been doing some research into the news stories that you've seen about people not wanting to live in densely populated urban areas, and they're all moving to the suburbs or further out. We do not find, except in New York City and San Francisco, we do not find strong evidence of a new trend. There was a trend that was already underway, which is after the 2007 to 2009 time period, the job growth after that recession was more heavily concentrated in the urban core than any post-World War II expansion. So if you were a young person and you were going to have a job, it was going to be in the inner city where they don't build single-family detached houses. But as early as June of 2010, when we started our national housing survey, 90% of millennials said, eventually, I want to own a home. In 2015, those millennials became the driver of the demand curve, and they also started moving out of the urban core because they were having families, needed more space, thinking about schools where they were going to send their kids. So in most urban areas, this has been underway for 3, 4, 5 years, and it's just kind of attached this story to it because of what was seen in New York and San Francisco. So I think in your major markets, they're in lower tax, lower regulation environments where economic growth has a lot of support. The business community has a lot of support. So job growth is going to be strong, and housing is more affordable in a number of those areas. Maybe not Fort Lauderdale, but Fort Lauderdale is another demographic that I think is going to continue to support it. Charlotte, probably more affordable. Tampa definitely affordable. So, I think those are markets that are going to perform well.
So on the margin, maybe the story's a little bit oversold at this point, other than San Francisco and New York, but that cities like the ones that we're in on the margin are probably, if we look at your forecast, they're probably going to be a bit more favorable than the forecast, simply because of the employment environment and pricing, et cetera, et cetera. So when this whole event started, we've told our viewers that the Fed had a responsibility and with monetary policy to step in, and I've watched them do things. Well, let's just say they took some pages out of the recent playbook from the financial crisis, but they've actually added to the playbook now. Pretty fascinating stuff. And then we said, well, the fiscal group will have to. Washington's going to have to help at this point. And finally, the medical field's going to have to go to work. All three of those kind of are going to have to really get after this if we're going to manage this crisis. Of course, the Fed checked the box, and the medical field seems to have created some therapies because death rates are going down, et cetera, et cetera. And of course, they're talking about warp speed vaccines. We'll get back to that maybe. What about stimulus at this point? How did you all have it baked in? Do you still have it baked into your forecast, or at this point, did you just assume Washington was going to do what Washington does?
Well, at the outset, there was an amazingly fast response by the administration and the Congress, and a huge response. I don't know that I've seen another one in my lifetime that was anything close to that. So both sides of the equation came to the table and did some things that were really very important and supported the faster than expected rebound. That some of that has expired, and there is a debate underway, and a kind of a bipartisan group in the House has recently broken a little bit of a logjam between the Senate and the House to make some progress. However, the death of Justice Ginsburg may well get in the way of there being an agreement. So as of this point, our forecast does not include an additional fiscal stimulus because there's just a lot of uncertainty around it. So what we want is for people to look at the forecast and say, well, this assumes there would be no additional stimulus, if there were an additional stimulus, things would be even a little better than what this forecast suggests. So that's the way to put that into context.
Got it. Thank you for that. So I have to ask, staying on the topic of your forecast, particularly going into 21. There's a little thing going on here in America in early November. It's not a football game. There is this competition, however, and how it plays out. Do you all have two forecasts? One if this side wins, the right, and one if the left wins, or is your forecast pretty much intact in either event? What's the plan in and around that for you all?
I'll take you back to my initial comments, which were the difference between scenario analysis and forecasting. So in our formal forecast, we only include those things which are certain and have a calendar date, or highly certain. We will make at the margin, if we can see that there's a majority in the House and a majority in the Senate that supports something, we will bake that into the forecast. Alternatively, we run scenarios. And so that's the way we'll approach the election, because we have no way of knowing in the next however many days it is until the election. And by the way, that time period, that will actually be rougher than football. It would be my And so what we will have to think about, what are the major policy proposals that are being made by either side to determine how that might impact things coming out. And remember last time when President Trump was elected, the markets were extremely volatile for a little while, because they really, first of all, they weren't expecting him to win. And second, they really hadn't done any analytics on what the major policy proposals that had high probabilities assigned to them would happen. So I would expect some volatility around the election.
Yeah. So HPSI, tell us what that is. I know you all are out collecting data from the marketplace, from consumers on the regular. Tell us what that looks like right now, and what's the latest from your survey?
HPSI is Home Purchase Sentiment Index, and our National Housing Survey, which we started in June of 2010, was designed as a sort of a pyramid to walk people through questions about how they are thinking about the environment around them, and get to how do those things impact their view on housing. And the thing that we are most interested in the long term, and this is something I know Supreme thinks about and has as part of their business plan, if you're going to be in the housing finance business, housing financing of people who want to buy a house is the one thing that will continue forever, because refinances are simply an option of your current mortgage rate relative to what the market rates are. And so we wanted to focus in on what's the sentiment of households about buying a house. And so obviously with the virus earlier in the year, we saw a big drop in optimism, but we have seen a rebound, not all the way back to where it was, but heading in that direction month over month as people have learned more, things have gotten more positive. But as I said, that very low interest rate environment, which we think will even be lower in the next few months, is a real lever for people who could conceivably buy houses, and has kept the demand side stronger than the supply side. Even though the supply side is now growing very well, we have this last month, the first time since I think 2006, over 1 million housing starts and 1 million permits for single family homes. So the builders, wow, they only make money if they build, and they're building.
Good. That's good news, because of course, inventory down the road. We've seen so many events in the last couple of years where house goes on the market, there's 6 contracts. Of course, only one gets it, right? So then there's people out. We've had a pipeline of folks that have been looking for housing. It's longer than it's ever been in terms of that time, the duration from when the initial contact to when they actually get under contract and actually close. We mentioned refinances, which is kind of a stimulus into the economy, right? I mean, it's this silent stimulus, but it's substantial. And go ahead.
The Fed is intentional in that area they're buying $40 billion of mortgage-backed securities a month. Part of that is intended to put a floor under the housing market. And those low interest rates allow people to refinance and improve their cash flow, which then frees up money either for savings or for consumption, which is a boost to the economy. So that's an intentional policy direction.
Well, we're doing some of them, but we're the nation, of course, is around 60% refinancing, and we're about 80% purchases. Our viewers today, many of them are realtors. We focus, start with Supreme on their business every day, because anyone can do a refinance, and we certainly are happy that they're getting done because it's a big stimulus. But the purchase marketplace really needs service providers to focus in and pay attention to their specific needs so we can move people from one place to another. We remind our realtor friends of that all the time. Biggest risk, when you go to sleep tonight, you're thinking about the forecast. What keeps you up for a minute or two?
There's two related things. One is there are a number of states and local jurisdictions that have put moratoria in place on evictions from rentals. Now, if the employment side doesn't pick up so that those households can have the income to get back and get current on their rentals, that might also mean that more of those small businesses are failing, which could eventually lead to layoffs of their salaried workers. And it's the salaried workers that have mortgages. The hourly workers tend to have rentals. The salaried workers tend to own homes and have mortgages. So that's the number one thing that I think about with regard to the housing sector right at the moment. And because that could conceivably lead to some of those forbearances turning out into foreclosures or workouts of other things, which would put some additional stress on the housing sector.
So we still need stimulus would still benefit then, because if we had particularly those that are still in harm's way about getting back to work, getting back to normal, additional stimulus would buy us some more time to allow the disease to continue to kind of quell in terms of the impact it has on people. Right. And that would help avoid some of the consequences you just described. Doug, last question. I always ask it to you. I thought it would be helpful again, because your advice on this, I always look to you as one of those not only really smart guys, but a guy filled with wisdom. Is it a good time to buy or sell a home?
Yeah, I've been consistent on this. It's one of the things that I try is to be consistent. So for probably 25 years, I've said, well, if you have a family budget and according to today's interest rates and the house that you'd like to buy that fits your family budget, it's a good time to buy a house. But disappointingly low number of people actually have a budget that they know where the money comes and goes. But if you're buying just because of the interest rate and you haven't done that background work, now you're asking me, should I take a bet that rates are going to go lower? Well, now you've moved from being a home buyer to being a speculator, and can you afford to be a speculator?
Yeah, so the good news on that front to our viewers is next year, Supreme's going to be introducing a new service, which is going to be called Budget Essentials. And when we get the initial call from customers being curious about buying, we're going to offer programs so that they can get into a budget building process, something, because as we both know, if someone hasn't bought before, there's more than just the mortgage that needs to be considered in terms of the cost of home ownership. Anyway, hey,
very much into the sustainable home ownership.
That's right. Well, we don't want to just give people a mortgage. We want to give people the opportunity to not only get the mortgage, but to enjoy it, so they can live there and know how to manage their cash flow, et cetera. Doug, thank you so much for your contributions again here today. And thanks for your most recent forecast that gives us all a bit of optimism heading into the fourth quarter. God bless you and Brandy, my friend.
Thank you, and you and your wife as well. Thank you.
Thanks. I again want to thank our good friend Doug Duncan for giving us his time today and his insights with regard to our industry. Isn't it amazing? I mean, a blessing that we're in an industry in the middle of the chaos that took place this year that is going to post an improvement this year. Year over year sales are now forecasted by Doug and his team to be up 1.3%. We started the year expecting it to be up 2.7. So we're still a little bit below the initial forecast, but an amazing recovery for our industry and a reminder to all of us about how blessed we are next year. Housing is supposed to be up 2.4%. So listen, I encourage all of you to be generous. Those that are succeeding right now, be generous with your neighbors, even if you don't agree with everything that they do or say or are for. Be generous. We all need to do that. We live in the greatest country ever. It's just like us, imperfect. But if each one of us does our part, if every single one of us, right, left, black, brown, white, believer, not, if every single one of us does our part and really leans in and is generous, not only with their dollars, but generous with our spirit, with our words, with our actions, we can help make this country the best it's ever been. So a nation divided cannot stand, nor can a family divided, nor can a business. Let's all stand together and let's do our best together. God bless every one of you, and we will see you next Monday for News You Can Use.